to set this week up, and when I say this week, we're going over what happened last week, May 25th to May 30th. So I would call this week a plot development week. In the Game of Thrones seasons type of framing. This isn't one of those weeks where you have a giant battle scene or a lot of action happens. This is like a plot development week, character development, setting up what's going to happen. Um, Maybe 2 to 3 episodes in, or the penultimate episode to close out the season, which always ends in a lot of action. That big action, big headlines is probably weeks out, several weeks out. That'll continue to develop as we get into the summer. But what we saw this week is really the first economic data, official prints coming in that show what's going on in the grand scheme of things with the tariffs really going on April 2nd. So if you recall, we said with the tariffs, these are like, think about it in terms of an offshore dollar phenomenon, right? You slow down from the US perspective, um, the incentive for the American consumer to purchase foreign produced goods as opposed to domestic, right? And so if you're sitting on the shop at the shelf, all else equal, you're looking at a good, shampoo, food, toys, etc. Whatever it is, and you don't generally pick up and see, where was this manufactured? Some of us do, but by and large, no one looks at that. We look at price and other features of the good that, help us determine value, quality, you know, warranties, etc. So where you really see the tariff having an impact, right? Where you set an extra charge on a foreign produced good, that should level the playing field, all else equal, for the American consumer to purchase the domestic produced good as opposed to the foreign. And this is, running counter to everything you've seen from the headwind for American manufacturing, domestic labor, all of that, um, and supply chains, basically a shift from a headwind to a tailwind. And so what we said, over the prior weeks, go back and look at the tapes. We said, look at the sweeps, and because of the American consumer, their buying decisions, if they do not pull back, if they continue to spend, what you should see is a large scale move evidenced in the U.S. Import balance. And so if you look, Friday, we got the first print for April international trade balance, so goods balance of trade. This comes from the U.S. Census Bureau. We got a huge surprise relative to economic consensus. So survey forecasted for April that the U.S. would run a goods deficit of negative 143 billion. Came in, almost, ballpark wise, almost half of that. So it came in at 87.6 billion. Now, relative to where we were in March, right? And there was a lot of front loading, inventories, purchasers trying to get ahead of that tariff going into effect that they knew was coming on April 2nd. That was, well telegraphed from the Trump administration, basically since Inauguration Day. Um, that March number came in at a minus 162 billion goods deficit, and so that negative 87.6 billion is almost a halving in that single month. So that's just the first month. And if you're the Trump administration, this is pretty much exactly what you wanted to see, right? The import of goods, all that slowdown in goods import is um, is basically a supply of offshore dollars that's taken off the table from the international money center. So the dollar, FX, financing, all of that's not in the U.S. financial system. Those are dollar flows that are basically not going to happen or not going to hit the offshore dollar. So that's really the big news on Friday of last week. That shows, where the rubber really meets the road on these, we call them now the Trump tariffs. But it really shows that Liberation Day tariffs, like, what are we calling them these days? Tacos is the new meme, right? Trump always chickens out. But this is showing like they're having the desired effect. So now, if you look at the Atlanta Fed GDP now, we're going to get into this, like the typical reaction you'll see from financial industry media, whether it's CNBC or in the Wall Street Journal, et cetera. The knee-jerk reaction was these tariffs are gonna, be Holly Smoot 2.0. We're gonna plunge the world into global recession. Hold that, hold that thought, because what you're saying now, assuming the American consumer doesn't slow down, right? What this is actually saying, if they keep purchasing goods and services, if there is that latent demand in the US economy, don't expect to see this recessionary scenario materialize. And so that what you saw from the Atlanta Fed with its GDP Now forecast updating in real time on that March 30 print was an acceleration in Q2 real GDP estimate. Now, these will bake in over the course of the next week or two as we get more data prints from just across the um, I guess bureaucracies that report and tally these numbers. But what this is telling you is actually it's not that. It's not a growth slowdown in the US story for the time being. We'll continue to watch. And I'll get into in a second what we should be looking at to help us determine which way this is going to break. But the early sweeps, that May 30th data print, which maybe the surveys didn't fully understand what was going on. The forecasters, April 30th, they had barely a slowdown in the goods import balance. If we go back to slide number 2, right, going from minus 162 billion to minus 143 billion. That's called, like, what would we call that in the forecasting business? Just a complete whiff. Dave, I don't know, Dave. I mean, you should have
Yeah.
saw that one. Should have done better, guys. Go back and like, this is their job. You should have baked that one in a little better. But
Hey,
yeah.
Matt, how far in advance was that survey? How many
What do you
weeks?
mean?
Do you know?
It,
When the survey number versus the actual, like, what's the lag in between the
oh,
the the survey
the
and yeah.
forecasters can update their data print like up until day of, just
Yep.
maybe Thursday of last week. It would have, you
Yep.
still could have been updating your print for that number. But the actual number is referencing, it's measuring imports of goods for the month of
Yep.
April. So it took, until May 30th to get that number tallied and reported to the
Yep.
street. But it's April 1 to April 30th activity. So if you look at this now, the Atlanta Fed publishes um, the contribution, weightings to its Q2 real GDP print, and you can see it. I've got it circled in red that goods import balance was a huge mover to that update last week. So that surge you see is basically showing, and if you think about it, real GDP inside of the US steps up. And what's happening there is, all right, the American consumer, assuming they're still showing up at the retailer to spend, is choosing by and large like half of what they were buying, just rough fudge factor here. Half of the goods that we were importing, we're now sourcing them from the domestic U.S. economy. That's assuming that they didn't slow down their spending at all. We're going to find that out in other prints as we get into GDP data with the consumer spending, the PCE component to tell us, did consumption actually hold up through this tariff policy implementation. But as of right now, the net effect is basically you're shifting economic activity, the production inside of that value chain that was taking place offshore, that's moving onshore. And now from that, you're going to start to see materialize inside the domestic US financial system, the banking system. as the complement, the financial complement of the real economy. So we'll get into that next. But Dave, Cameron, any questions, comments, feedback here on what's going on? All right. Did the U.S. already have, the infrastructure, supply chains, production already set up to compete? And then if that at that point, it's a question of capacity utilization, right? We'll get those metrics over time as well. But say it's a good that we don't have a perfect, production to spin up inside the domestic U.S. You can find examples of that, like the advanced lithography machines from like ASML, the Netherlands Dutch, producer. We may not be able to source those ourselves for now inside the US. So there are some critical dependencies. Rare earths production as well, right? Not necessarily because we don't have the deposits or natural resources inside of the um, US, 50 states, territories. It could just be production, right? We just don't have that set up, or we don't want to do it, right? Rare earths are such a dirty refining process. But it comes down to, like, do you have the ability? Do your own manufacturers or private sector, do we have that ability set up to handle the demand growth just from the tariff policy, the American consumer, without looking at the label, just being guided by price and the other attributes that go into consumer decisions, quality, marketing, et cetera. Do U.S. producers have the productive capacity to fulfill that demand by themselves? If the answer is yes, then you will see some degree of price impact, right? Slowly. Now, if we're ratcheting up towards, hey, we're at full capacity of the US economy's domestic production abilities, then you will see, price inflation, right? Start to pick up. But so far, those signs, like, we are very early in this process, right? This is the first month of data. But what you're seeing is pretty much on point with what we were saying on prior weekly roundups to expect. Watch for this goods balance to contract. Um, and that's a trend. So long as these tariffs stay in place, we should expect to continue.
If you look at the net exports number on 228, you had a similar the change in subcomponent contributions, and that's from the prior quarter. But if you go to GDP now, you have a similar spike, but I mean, this is just like the opposite. It's just flipped that spike the other way. So just an observation that I don't know, Matt, would you say just be careful what you're looking at with these projections?
On this slide, the slide we're on, slide 4.
On the surveys, like the survey error. I
Oh,
mean, it wasn't even an error; it was this complete Six Sigma whiff. So
yeah, since about, I mean, you could say the onset of COVID, but this entire decade, let's just say that it's been a tough one for economic forecasters. If you've built up your career, your models for 40 years, things are stable. The key drivers, basically the mechanics of how everything was set up was structured for like easy measurements, where like the thing you're trying to measure isn't volatile itself or constantly moving or in a state of transition. Ever since COVID, economic forecasters have had more error, I would say, in terms of the actual prints. I don't have the numbers up here, but this is just going by just my perception, my opinion, just watching these things come through, like non-farm payrolls, unemployment, inflation, down to like this one right here, the goods balance for April on the first month of tariff policy implementation. They're just off. They're having a more difficult time kind of nailing that target or even just being around it, right? So the accuracy of just the survey, establishment, industry, professional forecasters, it's
yeah.
off. And I think that's a sign of um, the state of transition that all of these big systems find themselves in. And throughout this entire decade of the 2020s, but continuing in April with tariff policy. And I don't see this changing, for the short and medium term horizon at the very least. If you're willing to zig where the rest of your peers zag, right? If everybody's caught up and still latching on to an old world setup, 1980 to 2020, or prior frameworks, you're still ahead of the game if you're willing to, you know, uh, express a variant perception against the consensus, right? So I think it like even this April print, it's still showing, um, yeah, the rest of the market, which is, you have to continuously update your priors if you're wrong, to become not wrong, right? Be on the right side of the trade. And if you're consistently wrong, well, catch up. Um, but I think this shows like there's still from the market perception, from the industry, economic surveys, all of that, professional forecasters, they're still playing catch up. And this is a situation that can go on for a while, right? Like from a all the way up to like a politics and policy standpoint, one of my favorite books, The Prize by Daniel Yergin, there's a quote from like a British prime minister after World War II had ended. They're in the 50s, and he's recollecting on everything he'd seen since, like the 1900 or 1910s, um, like from when his career began as like a clerk essentially in the British bureaucracy. And he said something like, I should find this quote and put it in the show notes, but he said something like, we've always been, we've come to the realization, this is after like 50 years, two world wars, a global depression, all the above. We come to realize we've been kind of operating on our back foot the entirety of essentially the 20th century. So these things can just like these periods where policy, capital markets, everybody is just they're in a constant state of catch up, right? You never feel like you're on it or you're always catching your breath. You're always reacting. In these states of transition, this can go on for years, right? Till everything's fully baked in and we've reached some, what feels like a steady state equilibrium, stuff like that. So my point there, this can go on for a long, long time. Sometimes it takes generations, right? You'll see, people in a government seat, a policy seat, even in business, when the world starts moving and adapting to these big picture things going on behind the scenes that you might not fully appreciate, in your position, your experience, it may just some of these situations, they just take generations to play out. So we'll see, like we may be in one of those, but I think just the pace of change, the volatility we've seen since COVID especially, this may very well be one of those kind of epochs in history. So the Fed's H.8 reports, they're a banking regulatory survey where commercial banks inside of the domestic banking system have to report um, to their Fed regional branch their balance sheet composition. If you're above a certain size, you have to do it like at the close of business every day, right? Um, so the Fed has access. Like it didn't seem like it when Silicon Valley kind of unraveled, and we saw that kind of period of volatility and Q1 of 2023, but they have a very good read in terms of just data composition on what's the current state of the financial system in the U.S. And these reports are about a week and a half delayed, so they come out every Friday. So what we're seeing here is reviewing, the snapshot is through May 21st, week of 2025. So you're always going to be a little bit delayed here. So your signal is technically it's ahead from a time measurement standpoint of what we saw in that April goods balance number, right? So this is more recent kind of measurement period than that, but we're still not real time, right? The only data you can get in real time is markets data. Like that's your actually source of truth, um, is how asset prices are responding. But if you look at the U.S. commercial banking system, how its balance sheet composition, amongst all the banks in the U.S. are kind of allocating on the asset side, and then we'll get into the capital side of the balance sheet next. But their asset side of the balance sheet will help describe what's going on the complementary side of that, which is the actual like real economy, goods and services. If you think about individual economic transaction, I go buy a sandwich for lunch, right? The actual production is the sandwich, and the financial side of that, sandwich for dollars, right? The monetary side shows up in the U.S. banking system. So if you think about this in terms of an imported good, right? If it's, I don't know, a new Xbox or something like that, manufactured in Southeast Asia, that's going to show up in the goods import data, and then that transaction will show up first in the U.S. banking system. It's a lot of complexity behind it, but what you would see, like if you're measuring, and we see this phenomenon in the real economy, like the goods balance of trade shrinking, what you see on the banking side of that and in the H.8 reports is kind of reflecting the other side of that economic transaction. All right. And so what we've seen on the asset side of the balance sheet, and this is just a 4-week look back, for month-over-month trades change. So April 23rd, 2025's report versus the May 21, 2025 report. What I do is I look at all these, just line items. It's a balance of accounts on these reports. And in the entirety of the financial system, U.S. commercial banks, sorry, that's just one composition of the financial system, but a key one, right? It's the piece that's anchored to the Fed, right? So it's the tightest definition of money, tightest coupling to the monetary element. Um, what you've seen, down at the bottom, you see if you're annualizing the growth of the balance sheet, you're seeing a 3.1% annualized rate of expansion. So this would be kind of footing to, how much is, if the banks are expanding their balance sheets at 3.1%, it's kind of anchored to like GDP or economic activity. The U.S. economy should be growing at something like that ballpark as your first estimate. Um, and then you see of the individual line items, what are they allocating to? Where is that balance sheet expansion coming from? Now, if we were in a recession, in the worst case scenario, you would see balance sheet contraction from your banking system, which is very, very bad. You do not want to see that from a credit system standpoint, instability, type of framework. But where that expansion is coming through, or even contraction on the individual line items, gives you a good sense of, or can give you a good sense of what's going on, in both the real economy, but also credit. So if you look at individual line items where they're expanding most, I'll start with the bottom. I group, what I call like cash reserves and collateral assets. So I put treasuries in here, cash assets. These are the commercial banks' reserves that they hold at the Fed and use to settle with each other. Fed funds sold in RRP, and then loans to other commercial banks. Um, if you look at like the biggest contributor to growth is cash assets. So banks are growing, like essentially they're topping off their reserve balances that they're holding at the Fed first, and that's contributing 4 points of balance sheet expansion out of a total of 3.1. So they're growing their reserves right now, in that immediate kind of just take the speed dial check, or measure the velocity, if you will. The banks are choosing to grow their reserves faster than they are the rate of growth of their actual uh, balance sheets in aggregate. So that tells you something first. It's like, all right, we want to make sure we have enough, dollar liquidity to meet at the Fed counterparty to meet all of the throughput going through the settlement that occurs between banks within the U.S. So that's first and foremost. That could be responding to an increased need for, like, if there's more activity, if people are processing more wires, right, for that run through interbank settlement, that could be consistent with banks wanting to hold more reserves, right? Because if there's more throughput and all else equal, you don't increase your reserves. If you get hit with outbound liquidity requests, well, that could drain your reserves too fast, right? So it could be responding to a pickup in um, actual activity, wire activity in the real economy itself. As we talked about the financial system being a complement to the trade and goods and services that occurs in the real economy. It could be that, or it could be a flight to safety, right? It could be, hey, we need more reserves because we're draining, et cetera. So it could be either one of those two, but if it were if it were the latter, like a risk situation, you would expect it to show up in things like the repo market, like eventually, um, things like that we saw in Q3 of 2019 that would tell you it was, that latter situation, which is not a, positive economic story. So the cash that you see, the banks increasing reserves on their balance sheet over the trailing 4-week look back on the most recent data, that's something to continue to watch, right? Because we already know, as we talked about um, in prior weeks on the weekly roundup, you do see other money centers like what we saw in the Hong Kong dollar, HIBOR overnight rates sitting at 3 bips, right? That's 3 bips on their essentially dollar pegged currencies reserves. That is telling you a situation where there's like a shortage of cash, shortage of dollars, interbank liquidity. I would call it almost a crisis, right? If you hadn't seen the pause to the tariffs, right, come through at the Geneva truce, something probably would have materialized there as that situation worsened. But so far, we haven't seen anything like that pop up in the U.S. But that's a situation we'll want to continue to monitor very closely over these next 4 weeks of June as we close out Q2. My base case is I think it's actually a situation where the U.S. consumer um, will continue to appeal or to spend, to consume, all of the above. I do not see the case for um, a real recession right now, and the data I'm looking at. That could be wrong, and we could evolve the other way very quickly. We're going to find out here in the next 1 to 2 quarters. But right now, I think it's actually the opposite. This is looking like a more resilient U.S. economy. All right. So now that gets us.
And
Okay, go
Matt,
ahead.
this is so the run it hot narrative right now there's no change in your base case. It's run it hot.
Exactly. And I think there's going to be such a strong, impetus from the fiscal situations backdrop, which is the real straw that's stirring the drink in all of this. We can't take an actual nominal recession or a real recession again. Like, we can't increase deficit to GDP like another level. Like, we can't do another 2008 or 2020 right now. So if we do get to that recession, we're going to have to just take it right in the face, cold turkey. That is such a bad outcome, or such an outcome that everybody wants to avoid, who is in a position to basically steer off of that course. there is going to be such a strong desire to keep us out of that ditch that I think we stay out of that ditch. Um, if we do wind up there, it's going to be, we're in a real bad way. But right now, base case, that's not where we're going, or where we're going to let the system veer off. All right. So now you get into, I want to talk about a little bit this other item. So we talked about the bank's cash reserves and collateral assets. You can think of that as like the bank's assets on the balance sheet, the proportion that they use for interbank settlement and liquidity, and reserves, safe assets, all of that. If you actually get into credit in the real economy, like lending into the private sector, that Cameron's still on the prior slide. Um, you see a portion of the balance sheet that's in what you call like bank credit, right? In that section of the balance sheet, you're on the wrong one. Total bank credit, 1.9%. They're actually growing. We'll try again later. It's 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 one it's one grouping down. So total bank credit growing at 1.9%
Oh,
annualized. No, that's 2.1. That's the other. That's So you're including that that 1.9% Cameron circled includes agency mortgage-backed securities, non-agency mortgage-backed securities. So it includes residential lending that gets packaged up into the securitized, um, what would you call it? Just supply chains, if you will. Um, and then some other securities that don't count for much. And then you add those in residential and commercial real estate, and then what's what I call non-real estate loans. I'll get into that. But this is how the U.S. banks lend into or provide money to the private sector. So households and corporations, right, are the big ones here, or households and businesses. And so if you look at where the growth is coming, right? The banks are, first off, 1.9% is like where you would clock the balance sheet contribution of of banks' balance sheet expansion into the private sector. 1.2% of it is coming from other loans. I'll get into what other loans means. But what I mean is there's say 1.2 per percentage points of growth from other loans. That's out of 1.9 percentage points total. So it's what that's saying in the measurements, how to read these. 60% of credit expansion, right? Bank balance sheet expansion to the private sector is going into this other loans category. All right. Now this is where I get into the footnotes, number 17 and 18. You can go down the Fed's H.8 report on the website, see what this means. Who are these loans to, right? It's loans to real estate investment trusts or REITs, insurance companies, holding co's or other depository institutions, finance companies, mortgage finance companies, factors, whatever those are. All right, that takes you're getting real niche there. Um, Federally sponsored lending agencies, investment banks, bank trust departments, and other non-depository financial intermediaries. So it's basically like lump that all in. That's what we call with the you call it like scary described term that got put on this in the 2008 crisis of the shadow banking industry, right? And then you look at the other, and then there's another section of others. It's actually two line items they break it out into. In footnote 18, loans for purchasing or carrying securities. So that could be repo, right? Loans to finance agricultural production, loans to foreign governments and foreign banks, obligations of states and political subdivisions, loans to non-bank depository institutions, like definition of shadow banking there, unplanned overdrafts, that just could be a corporate account, right? Um, Getting hit with an overdraft, pay 25 bucks per, right? It adds up for people who do that. Loans not elsewhere classified. So if you just, it's a catch-all, and lease financing receivables. So all of this is the non-bank lending that goes into the moniker shadow banking, right? Which includes private equity and private credit, right? So what you're seeing, like this trend inside private equity, right, and private credit, uh, follow. We've talked about this too on other episodes of Weekly Roundup, I believe, but you've seen a very strong push from the private markets or the alternatives industry to push for uh, exchange effectiveness, if you will, or launch of ETF products that would allow for private markets, asset classes, PE, private credit, et cetera, to be marketed towards retail. What that's telling you is you've got a liquidity problem inside of the alternatives, sector uh, the U.S. financial industry, which, if you read the headlines, right, you see situations like the Bill Ackman video at University of Austin, a few weeks ago, where he talks about the Harvard endowment being extremely overallocated towards illiquid investments like private equity, real estate, etc. That is where you would see a potential, slowdown in the consumer or in the, financial economy, etc. Um, really causing trouble. So right now, what you're seeing is very clear in the data. The regulated banking system, Fedwire banks, are spending 60% of their budget roughly in terms of credit expansion to the private sector. It's going to that shadow banking industry. So that's another situation to continue to watch very closely. What it really speaks of in the end is we're in an era, a decade of tight capacity for dollars on balance sheet, which is really another way of saying interest rates need to be high, right? Secularly rising interest rates. So those are like the core trends I see to watch on the asset side that look particularly interesting. And this kind of just rhymes with the thesis of we're in a state of transition, right? 1980s to 2020, right? You start with leverage buyouts, venture capital, private equity really taking off in the 80s, and that just turbocharged all the way through the ZERP environment of the 2010s. Now we're on the other side of that mountain, and all of this kind of buildup we've seen in alternatives for 40 years is now going to have to navigate this new era we find ourselves in. Any questions, comments there? Next thing we'll get into is the capital side of banks' balance sheets. We'll get into like trading assets, like banks trading fixed income securities with each other, liquidity needs, all of that. On another episode deep dive. We're not going to get into that this week. Now on the capital side of the balance sheet, right? This reflects how banks are funding themselves from like the capital standpoint. And so this stretches back for, how does the latest print on May 21st, 2025, um, how would each one of these line items grow on an annualized basis over time in terms of contribution to that growth? And so the two that I'd call out here are, number one, deposits, right? This is other deposits, which is your non-time bound fixed deposit. So certificate of deposit, you go into your bank, you lock up your money for 3 months, 6 months, a year, 2 year, not long term, but it's a fixed lockup period. That goes into that line item above this one that we're covering called large time deposits. Other deposits is just demand deposits at a bank. Hey, you can hit me for this cash, or transfer this cash from JP Morgan to Bank of America today. That's other deposits. And so what we've seen on the look back from May 2021, you see the red there. Deposits are actually down. They're contracting. So this is going to be interesting to watch. So this could be like reflecting, hey, you know, private sector wants to pay down credit, or there's just more usage of deposits, so there's not as much funding capacity available through um, just savings to the U.S. banks. This is why, all right, if you want to attract deposits as your U.S. banking system, all else equal, what do? Raise interest rates. So this is causing pressure on short-term, front end interest rates to remain high, which is why you're seeing this wait and see approach from the Fed. You don't want to get this wrong. If you cut too early in your Jay Powell, um, you risk putting more pressure on banks' balance sheets from the funding side, as all else equal, deposits want to contract if you were to um, lower rates. And I mean from a private sector standpoint, right? So right now, what you're saying, we talked about this before, other offshore dollar interest rates, like HIBOR, for example, are extremely low, sitting at 3 bips. With the US parked still at 4 to 4.25 on the front end policy rates, that is keeping deposits, up and stable for US commercial banks' balance sheets. Now, on the other side of that, we do need to see balance sheet expansion, right? On the total. How do we balance those out? It's coming from borrowings. And you can see this, you go into primary issuance for investment grade markets, seeing a lot of financial issuers. I can just go through HSBC, USAA, Jackson National. I'm just reading off my screen. RGA, and like this is just in like since Wednesday of last week. I could scroll down. There's a ton of financial issuance coming out in the investment grade space. Um, so the U.S. commercial banking sector, it's very clear in this data, starting with April 16th, they're increasing their borrowings. This would be debt, like going out to the private markets or sorry, public markets and raising debt, how this most often happens. And if you're a commercial bank who doesn't have the capacity to go issue, a public bond, the QSIPs we think of that are broker dealer supported in the bond market. What do? You go tap a bigger bank to help you raise that financing, is how this system works. So after you get through the quarterly earnings call, the banks are the first to go by design. Friday post quarter, first ones out the door, JP Morgan, Morgan Stanley, et cetera. They all go first, and then that opens them up to go tap the debt markets. That's exactly what we saw starting with mid-April, following the first week of the Trump tariffs. As things started to cool down, you saw the commercial banks tap public debt markets in size. So they're growing their balance sheet. That's a 9.5% contribution to growth versus, remember, from the other side, we saw 3.1% on the trailing 4-week look back. Wait, sorry. So the 9.5 I referenced there is just 1 week. So if you go to the 3.1 on the 4-week look back, you're seeing a 3.9% contribution to growth. No, sorry, don't ignore that, Cameron. Go to the 4-week, 3.1, and then 3.9 on borrowings. So that balance sheet expansion was over the last 4 weeks of measurement that we have. It's being funded through the public debt markets. That's why I use 4 weeks. It's a look back window that gives you a long enough period to clock a measurement, right? It's like forwards backwards methods at calculus 101, right? If you go instantaneous, you're going to get too much wiggle, right? Because 1 week is too short. You're going to get a lot of error in your measurement. But if you want to look at the local trend, stretch back over 3, 4 weeks, something like that on intermediate. Now, if you go too far, like a quarter, a year, you'll see the big trend, but you won't see what's happening. Like, how are the businesses reacting in real time to a big transition like we saw April 2nd, right? That's a big shakeup in the global economy, supply chains, international trade, which plays through the domestic financial or domestic economy. which is then going to materialize through the domestic financial system in the US. So that's why I think 4 weeks is kind of that good window to get like a good read as you're trying to take a derivative measurement, if you will, and watch trend. I'm talking derivative in a mathematical sense, not swaps, options and other derivatives. And this could be like this could go either way. This could be, it's still not clear that this is like if deposits keep contracting at a rate of like 14%, like for contribution to balance sheet expansion, that's going to be a huge problem. And we're going to have to come in and address that extremely like sharply if you're a policymaker, right? Um, versus, hey, if this is just volatility, because we've been kind of knee jerked back and forth, tariffs on, tariffs off, all of these things. It could just be week to week measurements responding to like an increase in underlying volatility, which is also true. So to get a sense of like still what you need to respond to here is US private sector economic activity. That's what you're watching for in the banks. And so or from the banking system's perspective. So you need to like continue to watch this very closely, and this is what our policymakers are really doing. It could at at this point it could break either way, but my base case would be the U.S. private sector holds up just because they're sitting on the strongest balance sheets that they have since the 2008 crisis. Um, really inflicted a lot of damage on them. Um, but they're sitting on strong balance sheets. By and large, if you look overall, um, they've delevered, and there's a ton of impetus from your largest consumer class ever that's ever existed in the history of the world that's hit their retirement age en masse, and seeing a lot of boomer wealth just sitting on kind of use it or lose it in their golden years, and that goes from travel, tourism, consumption, new car, all of the above. So um, there's so much kind of latent demand in the U.S. industry. I would be surprised if the U.S. private sector did not, hold through this. But you could see the other, right? Where there is a slowdown and that materializes into risk inside of the U.S. Um, commercial banks, balance sheets, financial system, et cetera. But that's not my base case right now. So we talked about just kind of intermediate conditions till we watch end of quarter. We'll get a better sense of what's going on in the key economic data prints and also the financial system prints as those reports continue to come in over the coming weeks, and we just get a clearer view on what's happening with international trade and then financial asset flow or financial capital flows. But a leading indicator, as I said earlier, uh, the only place you can watch in real time to get a sense of what's going on is in price. That gets us to our key macro assets here. I put Bitcoin up on the board. I know we've got a lot of our audience who are positive on their Bitcoin thesis, ranging from positive to strongly positive, I would say. But just watching the technicals for trend is key. And we saw some interesting things on Friday last week, May 30th, on kind of a breakdown on support, right? What we had been seeing is higher highs, higher lows on Bitcoin during its up channel, if you will, from mid-April, post the April 9th reversal on the Trump Liberation Day tariffs, right? basically that recovery from Bitcoin at about 75,000 all the way up to that new all-time high at 111,000 about a week ago. Um, you saw a break below that support line, which I highlighted in orange, right? So this is totally normal behavior. Like you go on a run, two steps forward, one step back. The more of those you put together, overall, is just kind of defines that you're in a bull market over longer term time horizons, and that's exactly what we see with Bitcoin. Uh, right now on the the short term cycle, but also like 4-year look backs on a halving cycle framework, or then even, much longer in terms of the 16 years that Bitcoin has existed. But if you see that crossover there, the break below is signaling that, hey, we potentially are going to see some softness in Bitcoin here for the, potentially coming days, maybe weeks, etc. Very short term. I found that interesting that on the exact same day, the break trend on that goods print, we saw very similar behavior from the complete mirror image asset, if you will, from Bitcoin as long duration treasuries, right? For high duration macro asset. So if you look at this is my favorite treasury bond, May 2050 1.25 coupon. It's the lowest coupon ever existed on the 30-year, or that's ever been issued on a 30-year U.S. Treasury. We saw something similar, right? A breakout against resistance on what's following a strong bear trend in complete opposite antithesis, if you will, to Bitcoin itself in long duration treasuries. So same scenario, except for different directions. Bitcoin price chart moving up and to the right on that short term channel that I showed on the previous slide. Or if you zoom out, it's up and to the right, for 15, 16 years now. For U.S. Treasury debt, it's been, a down and to the right scenario, a bearish trend for long-term treasuries. But my point here, what I wanted to highlight, it's literally to the day from Thursday, May 29th to Friday, May 30th, we saw a crossover against prior resistance or support, like against primary trend for each of these respective asset classes. But in long-term treasuries, specific case, there was a crossover of resistance, lower highs, lower lows, onto the other side of that prior trend. And that's basically what we've seen over the last, let's say, 2 sessions in trade and U.S. Treasury trading, both Friday and Monday. I'd say, if you're looking for, a trend reversal, it looks pretty weak right now from treasuries, but this is a situation where, hey, treasuries, instead of that sell-off we saw throughout April, but really into May, where we hit a new low, it's just kind of what we're looking at. If you see a temporary pause, it could be days or weeks, right, is what I kind of measure this at right now, or expect, of just a let up and the upward pressure on what perceived risk assets, right, like Bitcoin or the Qs, the Mag 7s, or a few of them, if you will. Now, I'd be watching for that to pull back as treasuries, find themselves in some footing here. But I'm not just given the weakness we've seen since April 2nd, right? I don't expect to see any massive bid coming to treasuries, right? So the bull case for treasuries would have to be that an actual recessionary scenario develops. There's a flight to quality to get that longer term interest rates on U.S. Treasury debt to really come in. I don't think that's my base case, but if it were to materialize, that would be the bullish case for treasuries. I think what's much more likely, if you look at this, so I didn't zoom out the chart full enough to get the 2 points, but if you see the dashed line in black, you can see where it connects to the most recent sell-off. That's your kind of your current support. If we break below that, we're going to be searching for a bid, right? It's just, open season. We don't know um, where the next level of support will ultimately come in for long-term treasury yields. So I think that's the key risk right now for treasuries. But we've already seen that you see in blue the upward sloping channel, very weak but positive, that U.S. Treasuries have traded within for basically most of 2024 into as far as middle of last May, where we finally broke below that. This is still a bearish setup, in my opinion. But that temporary kind of reversal, jumping across that resistance line says, all right, for the next maybe few days or potentially weeks, expect that volatility to slow down in treasury land. But overall, the background context still looks pretty bearish. I'll just, I guess, say that. Ultimately, like my framework is we need higher rates, right? Interest rates want to go higher. So overall, this is a story where, all right, there will be continued weakness in the chart. But for this crossover, right, how do you get the breakout, right? Well, it came on the goods order or the goods balance of trade economic print. And I would say it's probably like the start of it is look for the actual print. What happened? What is the actual news you have to point to? Dave, we're in the middle. Welcome back, Dave. We lost him for a second there. But I would look to what we saw in that print, that information we saw come in on May 30th, to define what the market is seeing here. So the start is, all right, we have goods coming in, right, from a balance of trade, way smaller of a goods deficit than had been expected. What could interest rates be saying in response to that? Well, it means, all right, so far consumption has held up. And I think it just took it as the initial sign, hey, the economy or the US economy didn't just immediately roll over in response to this first month of tariffs being in effect. So it starts with real growth stabilizing. First and foremost, it's a positive in the event that, all right, we saw this come through, got a month, things are still holding together. And so far, right, okay, to make long-term yields continue to rise, you got to do two things. You got to have positive, or you got to have real growth expectations increasing, and/or inflation expectations increasing. Price from a price definition, or even more specific, you got to have the sum of those two widening. So right now, what you're seeing from the long-term treasury debt is basically like those things are just kind of staying in a steady state, if you will, or finding some sense of balance after 1 month of data. I don't think it stays here. It just means, all right, we're going to take a little pause after this brief move and wait for kind of the next shoe to drop, which could be July, August. I'd almost say it's likely to be July and August as this situation in Washington, D.C. with the one big beautiful bill, debt ceiling, all of that comes to the front of the calendar. And then also don't forget we've got the initial 90-day extension, set to expire about July 4th. I think the EU tariffs are set for an extension. This was last week's news. EU tariffs were supposed to go into effect July 1, or sorry, June 1. Donald Trump extended those to July 9th, I believe. So there's some headline events that the calendar is like walking towards. But it seems for now, if you're looking at treasuries, it's like, all right, we're going to stabilize here for an intermediate amount of time. But there's also, potentially like the risk is, on this chart, price continuing to decline, and ultimately what that materializes in is the same way of saying higher interest rates on the long end. This ties into how we started the week from a macro, events kind of framework. We got this tweet from Donald Trump. We're used to seeing some truths, if you will, that we have to very rapidly reassess, where we're at as traders and all the key asset classes, fixed income, the dollar, equities, et cetera. But this one on Monday, my view, is really telegraphing the state of the situation with respect to Ukraine, with the key participants at the table being the EU and Russia. So this positioning, how Donald Trump laid it out, remember over prior weekly roundups, we discussed, all right, is there going to be a peace? Hey, we're going to have peace within a day, is it was kind of promised on the campaign trail. We have a minerals deal, the U.S. With the current government of Ukraine, which signed, maybe 2-3 weeks ago. It's hard to believe. But on Monday, we got this tweet that came out, basically Trump saying, Putin's essentially gone crazy. He wants to take all of Ukraine for himself, et cetera. And I think just read between the lines here on what's going on. I think this is the tell on where things are going in this conflict. What Donald Trump's doing here is he's kind of walking away from this mediator role that we've kind of operated in since kind of the November elections, right? Start out from the Biden administration, it was like, well, the U.S. is helping fund this thing. It's like a key ally supporting the Ukrainian front. The new Trump administration, you kind of saw a change in that relationship from, hey, U.S., we can't keep supporting this. We are not going to keep, adding to our own fiscal deficit situation to run this tab up because we couldn't afford to, is the reality of it. But that role shifted from like participant and ally of EU, and my opinion, to like a settlement negotiator, which has slowly over the course of the last 3 to 4 months slipped away from possible to what looks like, unfortunately, now not possible. So I think what this is saying, Trump is positioning us in the world, basically saying, hey, I tried, we're going to walk away. We're like, there is not going to be a peace settlement, contrary to where, perception was at as recently as, maybe a few weeks ago. But unfortunately, the situation looks like, Russia's not going to stop, right? EU views this as pseudo, or like almost to the point of existential for the continental experiment, right? That is the EU, of like uniting governance together. So, the sad fact of the matter is, it looks like this situation is just going to have to wear on, and I think it's like even worse than that. It may actually escalate, which is what you saw. The immediate reaction from Merz from Germany, speaking to, I think it was media, not like a conference panel, but it was a media interview. He basically said they've taken the constraints off of Ukraine and the scope of attacks. They can attack into the, Russian territory with NATO supplied weapons. And so what you've just seen from this is actually like, instead of settling this thing down and getting to a peace settlement, it's actually going the complete wrong way. And so where does this hit the road in financial markets, right? Well, from the European side, this conflict is going to need to be financed. You've got all of the basically G7 kind of participants behind the Ukrainian front, um, in a heavily indebted, situation, high debt to GDP, all of that. So you're going to need to find a way to keep financing this war. I've talked about before, how the Ukraine side, it's basically, 60-40 funded from the Ukrainian domestic currency, the hryvnia, no capital markets outside of what's inside of Ukrainian sovereign control. And the remainder is funded by international capital markets, which is majority weighted by the dollar. So it's the offshore dollar financing. So in this environment where you see continued pressure on, hey, yields want to go higher, we just talked about that with the Treasury, it's going to be more and more kind of urgent. How do you fund this war from a capital standpoint? And just where all this is going, um, this is going to play into the course of interest rates, and what these offshore money centers, think European money centers, London, Frankfurt, Paris, kind of less, much smaller than London. Then you've got like Gibraltar, all of the Commonwealth money centers that can flow dollars into funding this. But this is going to have an impact on interest rates, and funding war ultimately gets expensive. And I think this is just over the more medium term time horizon. What we now know is this war is going to continue to go on. We were not successful in the initial months of the Trump administration of putting this one back into the bottle. And so that is going to materialize in the quarters and years ahead into the overall like yield curve situation, and the state of dollar capital.